All right, quick one. Okay, just a quick check. You should be able to hear me, plus you should be able to see my screen as well, yeah? Good. Okay. Cool. So thanks, Fong. And Dong here say yes, all right. So I think everything is great. Okay, we'll give maybe another 1 minute or so so that everyone is able to join in. Okay. Good. Okay, we'll get started for today's session over here. Cool. Okay. So first thing, I think thank you everyone for actually taking time off to join us on a weekend. Okay. Seldom we actually run webinars on weekend, and this is like the first time they say, let's try out and see if the response is good. I think not too bad. And you guys actually committed to taking an hour off from your weekend and join us over here, right? Good. So let's get started. Today's topic here I want to share with you is how can we trade in an environment that I would say majority of the central banks are essentially hiking rates. Okay. So it's actually kind of a different approach to analyze the market. Okay. Because a lot of times, we either look from just purely the fundamental aspect, when we say that central banks are hiking rate, generally the currencies are going to increase in value, they're going to strengthen. The opposite is true as well, but at this moment, almost every banks are hiking rate, right? So how are we going to approach it? That's where today's webinar will give you some insights into it. Okay. So first thing first, of course, a quick disclaimer over here as well, because we might share some of I would say, actual opportunities to trade the market. And if let's say, you're fairly new to trading, just make sure that you're aware risk is involved, okay? Good. So by the end of today's presentation, this is what I'm hoping to cover. Okay. First thing first, we're going to talk about what is yield differential, how we can actually use this in the current market environment to spot for opportunities. Okay. This is where when every banks are hiking rates, how do you still, from a fundamental point of view, seek out opportunities to trade the market. Then we're going to talk about leveraging on high impact news as a potential catalyst for your trade setup. Last Thursday, if you were monitoring the US CPI, that's a classic example of leveraging on high impact news. For those of you who managed to capitalize on that, that's great. Okay. If not, then no worries as well, because moving forward, almost every other month, you're going to have an event that is interesting to keep an eye on, and that is going to present to you opportunities, right? And today we're going to also cover how do you then combine the fundamental process plus the technical analysis, put them together to help you identify opportunities that you can trade. And then from there, we're going to go into the live market environment and seek out opportunities, right? Good. So with that, along this sharing session, you might have questions, right? I would strongly suggest perhaps you want to write it down first. And then, at the end of the presentation, when we open up for Q&A, then you type in those questions into the chat box, and then I'll be able to look at it and answer, right? So I wouldn't want to go through halfway and then there's questions coming in and then, everyone get distracted. Okay, so what we're going to do is I'm going to go through the content that I've prepared for everyone. And then at the end of it, we'll have a Q&A. So that's where you type your questions in and I'll answer your questions along the way. Okay, good. So this is for who, okay? If let's say today you have some experience in trading, you're active in trading, hopefully today's sharing can give you a different angle to that. If today you're fairly new or you just got started, then of course, today's sharing is definitely going to benefit you as well. Okay, so again, it doesn't matter whether you're new or experienced. I think whenever I prepare a sharing, I do my best to cater for everyone. Okay. So a quick one about me. I think majority of you probably have got to know me, heard some of my sharings, but for benefit for those of you who first time joining in, just a very quick one about myself. So my name is Yong. I started trading back in June 2012. And of course, to date, that's just about 10 years. And throughout my process, throughout my journey, I've come across and tried out many different methods. Okay. And of course, when I mean methods, I'm not just referring to different forms of indicators, but I've looked into how we can study the fundamentals, study the macro aspect of the market, seasonality and things like that, right? So it's actually from multiple approaches. And something that I always stress is there is no such thing as the best method. At the end of the day, I always say the more you know something, the more empowered you are, and you have then the power of choice, right? You can then choose this one I like, this one I don't like, this one fits me, this one doesn't really fits me. And then you can then synthesize a strategy according to your style and your personality, right? So that's the whole idea of it. And that's why whenever I do a lot of sharings, I always share what I know, and I do my best to give you as much tools as you can so that you can then, go and find out what fits you, okay, as an individual, yeah. One of the biggest lessons I learned in the market is by bursting a $20,000 account. And basically the lesson I learned from that is risk management, right? So I think today over here, if you're fairly new to trading, the first thing that is very, very important for everyone, doesn't matter what strategy you use, is to learn how to manage your risks, okay? I turned full-time by the end of 2015, and to date, since then until to date, I've been doing this, and this is something I really enjoy, okay? And I always share, I'm not someone, people a lot of times like to say guru, right? But I always share that I'm not someone who kind of claims that I know everything. But what I love to do is I like to share what I've learned, what I know. Obviously, the market is always right, and obviously what we want to do is always learn from the market, and it's always evolving. Okay, so there's no like end goal to it. And you need to be really passionate about trading and investing, and you need to really enjoy the process to be in it. Okay, so there's something I like, and just very quickly, share with you some of the photos that we have. These are some of the physical events, and moving forward, right, there are going to be more and more physical events. Some of you perhaps joining in from Malaysia, some of you from Philippines, some of you are from Singapore. Hopefully, okay, moving forward, we'll have more opportunities to connect with you physically. Okay, good. So with that, let's start off by first understanding what is yield. Okay, and today we're going to talk about FX yield, right? I think other than FX, there's not much of this method, right? Or I say this method, other than the currency market, you can't really use this to analyze it, okay? So this is kind of unique because it's really designed for understanding the currency market. Okay, so what is FX yield, right? The word yield itself is actually also known as like returns, right? How much profit can you get out of it? So FX yield over here is actually referring to the interest rate, or I would say the interest that you can receive from actually holding on to a particular currency. Okay, so give you the simplest way of understanding, right? Is today you put your money into maybe fixed deposit. Okay, put it with the bank. Maybe in a year you can get, I don't know, depending on which country you're in, okay, maybe about 4 to 5% in high interest rate environment. So that 4 to 5% becomes your yield, right? Because today you put into fixed D, you put into fixed deposit, you don't touch it. After a year, the bank pays you about 4 to 5% interest, right? So that becomes a yield. Okay, so if you think about FX yield, you can think along the line of if today you put your money in the bank, you don't touch it, how much money can you get? Okay, so that's like your profit, quote unquote. Okay. And the yield is often affected by interest rate, right? Because in a high interest rate environment, the yield that you're going to get from it is going to be higher. And the opposite is true, right? If today we are in a low interest rate environment and then you put your money into fixed deposit, the banks are going to pay you less. Okay, so that's how it works. And if the interest rate is expected to increase, right, then yield tends to increase as well. Now, if you just compare like last year fixed deposit interest, doesn't really matter which country you're in, but generally they are the same. If you just compare like last year and look at this year's one, the same bank offering the same fixed deposit, the yield has already increased. Okay, I would say almost all banks have done that. Okay, so that's the whole idea of it. Okay, when interest rate increase, we generally would expect the yield to go up too. Right. So if you take a look at this chart here, right, this chart is the US 2-year yield, right? So just now I give you an example of if you put money in a fixed deposit for 1 year. Okay, so that becomes like 1 year yield. If today you look at the US market, okay, obviously you don't put your money just into the US banks or US fixed deposit, but the alternative is US government bond, okay, which means that the concept is the same, but instead of the bank, you kind of buy a bond from the US government, and in return, the US government promised to give you an interest. Okay. So there are many different durations of bond, right? You have the 1 year bond, you have the 2 year bond, you have the 5 years bond, you have the 10 years bond. Okay. So for short-term trading, majority of the traders would use a duration of 2 year bond. Okay, so it's not like too long, but it's also not too short, right? So 2 year bond basically means if you purchase a government 2 year bond, you're essentially telling the government and say that, okay, you take my money, whatever you want to use it, it's fine. But 2 years later, you're going to return me the principal amount plus whatever interest that you promised me. Okay, so that's how government bonds work. Okay, so that's where a lot of times people would say, oh, government bonds are the safest because the government will not default on you, right? When they promise to pay you, they'll pay you. Okay, so if you take a look at US 2-year government bonds, it has been rising, okay, for this year itself. And that makes sense, right? Because the Fed has been increasing rates, and therefore the yield here has also been increasing, right? And what does this translate to is if you take a look at the chart of the US dollar, okay? So this is the year to date, right? YTD stands for year to date. So from January until where we are, recently, of course, the dollar dropped, okay? But let's take a look at the overall trend. You see that the dollar has been rising as well, right? So it can give you an overall perspective where if today the yield is rising, there's a very high correlation that the dollar is going to rise as well. Okay, so they can move in similar direction. Okay, so if you put two charts together, you can see the relationship, while not all the time 100% exactly the same, but generally they look the same, right? When the yield goes up, the dollar goes up. Okay, so what this means to us is we start to study the pattern, start to study this relationship, and we figured that the 2-year bond yield has a very nice little relationship with the currency itself. Okay, so if you are talking about US, then of course we relate to the US dollar. If you look at the pound, right? So you look at the UK government yield, same thing, 2 years, and then you look at the GBP, they have a very similar relationship. Okay, so this means that the currency direction kind of tracks the country 2-year yield quite closely. Okay, so why this matters to us is because if today we want to, from a simplest way of understanding fundamentals, okay, is to look at where the yield is going to give us a general sense as to whether the currency is going to strengthen or weaken. Okay, so if today interest rate is higher, naturally investors would say, okay, I want to put my money there. Okay, this is quite common, right? I mean, it might not only happen in the FX world, but within the currency market, you tend to look for stronger currency. Okay, so give you some example, right? If today you're based in Malaysia, okay, the ringgit has already weakened relative to the US quite significantly this year, right? I mean, I still remember like late last year, early this year, the exchange rate was about what, 4.4 something. That means $1 is about 4.4 ringgit to 1.45 ringgit at worst, right? But if you look at today, right, it's already like 4.7, 4.8. Right? So naturally, a lot of investors would think that, oh, if the Malaysia ringgit is dropping relative to the US, then what they might consider is to exchange for US and the whole US, right? So that's how investors' thought process are. Okay, so wherever there is a higher interest rate, it will lead to the currency strengthening, and therefore there will be more demand for that. Okay, now, so that's how the whole relationship happens, right? So why yield would then impact the value and the price point of a currency, okay? Because they have this effect in the market. Okay, so fundamentals simplify, right? So I just want you to know, of course, this is like not the only thing that you need to understand from a fundamental point of view. There's still many other different factors, right? When we talk about fundamentals, we also understand the economic indicators, you know, how the economy is doing, what are the central banks doing, are there any shift in their monetary policy and things like this. It will affect, right, from a fundamental point of view. But looking at a yield kind of simplify it, right? Because if today you have no background about economics, then now you just look at charts, okay? The visual aspect kind of help you simplify the fundamental of it, okay? So this one here is where, just like I mentioned, okay, if the interest is rising, interest rates are rising, the yields are rising, then there's a very good chance the currency will strengthen too. Okay, so that's the effect of it. Okay, the opposite is true, right? If today, you know, we never know, but maybe next year onwards, okay, by maybe third quarter or closer to year end 2024, there's a good chance we'll start to see the shift towards maybe cutting interest rates. Okay, and that's where the yield are going to start coming down, and you want to then also utilize what we covered today to help you kind of trade during that kind of environment. Okay, so both directions are true, right? If you are rising, currency tends to strengthen. If you are dropping, currency tends to weaken. Okay. So one way, of course, is that we can look at the yield itself to help us identify the direction. The other method, okay, is we start to combine this thing called yield differential. Okay, because if today you're trading the FX currency, you're actually dealing with two currencies at the same time, right? For example, if you're looking at euro dollar, you're looking at the euro and then you're looking at the dollar, right? So that's where you want to compare two countries' yield, okay? And that itself, we call it yield differential, okay? There's no complex formula to it. Basically, what we do is we take the euro, for example, a euro dollar, we take the euro minus the US, okay? So we just take the difference between these two yields. Okay, so euro, of course, is a zone, right? So we take Germany as a representative of euro. So we take the German 2-year yield versus the US 2-year yield, right? So we kind of minus it. Okay, so you, after minusing it, if it's a negative number, it means that the US yield is stronger. Okay, so I think that makes sense, right? Quite clear cut. If the ratio is increasing, which means if it is a positive number, then euro yield is actually stronger than the US. Okay, so quite straightforward, right? We just basically take 2 years, the 2 yield, and then you just minus off to find the differential. Okay, so if today in this slide here, the example I put is if the German 2-year yield minus the US 2-year yield, and we get a negative number, which is coming down, it means that the USU is stronger relative to the German's U, and therefore we expect euro dollar to be falling. Okay, so that's where it starts to build into that relationship. Okay, so similarly, if you are looking at another currency pair like US CAD, then you'll be comparing the USU versus the Canadian U. Okay, now if the US versus the Canadian U is rising, which means you take the USU minus the CAD U, you get a positive number, which means US is stronger, then we expect the dollar CAD to be rallying too. Okay, so that's the general relationship. Okay, now you take a look at some of the charts that I have over here. The blue line is your yield differential. Okay, so it means that we take the German minus the dollar. That's the blue line. The orange line that you see is the price of euro dollar. Okay, so you can see quite similar, right? When the blue line is falling, the yellow or orange line drops as well. The direction kind of looks similar. Okay, this is the dollar versus the Canadian. Same thing here. Blue line is your yield differential. The orange line is the price of dollar CAD. They move quite similarly as well. Okay, so in usual times, one way to understand or look for it is if the yield of a differential is going up, then it kind of tell you that, okay, the trend of this particular currency is likely going to continue going up. And if the yield is coming down, then you want to look for, okay, that currency pair is also likely going to come down, right? So in the simplest way, you can look for it for a confirmation perspective. Okay, so that's the simplified version of fundamentals. Right. The other approach, which I'm more interested in, okay, is to look for divergences, okay, because that's where you're able to start to identify potential turning points. Okay, so what are divergences, right? Divergence is a concept where two things are moving in opposite direction, or in other words, they are not moving in the same direction. So divergence in yield differential is basically where the difference in yield and the price of that particular currency pair is moving differently. Okay, so meaning one goes up, one comes down, or one goes down, one goes up. Then we spot a divergence. Okay, now often this suggests that something is wrong. Okay, wrong meaning quote unquote, yeah. Because most of the time they tend to move similarly, right? So when we spot the divergence, it means that, okay, something is off in the market. We want to pay attention to that. Okay, because probability suggests that there's a very high chance it will converge back together, which means that if they go away from one another, there's a good chance it will eventually come back. Okay, and that's what we call the turning point, right? Because if it's going further away, at one point in time, we know there's a high probability it will U-turn and come back. So that's the turning point that we can actually capitalize on. Okay, so if you take a look at this example here, right? This is like super clear cut. Okay, the divergence is very obvious, right? The blue line is going up. That's basically the pound versus the US yield. Okay, it's going up, but the pound dollar price is coming down. Okay, so one is up, one is down, different direction, very clear cut divergence. So what this means is that we then expect the pound dollar to be turning back up, and then the yield differential of pound and US to be coming back down, right? So they have a probability of coming back and meet each other again, converges. Okay, so from a trading perspective, right, when we spot something like that, we know, okay, I'm not gonna short the pound dollar anymore, but instead I'll be looking, can I get a reversal for the pound dollar, right? That becomes my opportunity from a fundamental, plus potentially we're going to talk about technical entry. Okay, so that's where we're using the yield differential from a fundamental thought process to identify opportunities that we can capitalize on. Okay, so you can see over here, the reversal was sharp and they eventually start to converge back, right? That means it comes back and meet each other, and then eventually they will form a same direction again. Okay, so divergences are not like forever, because eventually both of this will very high chance converge, right? Come back and meet one another. Give you an example, right? This is like Aussie versus the dollar. Okay, so you can see the yield is going down, going down, going down, but the Aussie dollar price is going up, going up, going up, going up, right? So that's a divergence. Okay, and then eventually the reversal was sharp, and it came back down and meet each other, right? So it kind of converges back. Okay, now at this point in time, you might be thinking, okay, so when do I get involved? When do I buy? When do I sell, right? We'll talk about it as we progress. But up to this point here, I just want you to be able to understand and be able to see how the yield differential creating divergence with your currency price starts to give you an opportunity to pay attention, right? So in the future, when you're monitoring the yield differential and the price of a currency pair, and you start to see, oh, there's a divergence happening, that's where you want to start pay attention to that, because it means that moving forward, there's a very good chance there's an opportunity for you. All right. So this means, again, just to kind of reiterate the point, it presents an opportunity when there's a divergence, and usually this suggests a reversal trade setup. Okay, good. So just to highlight a little bit, right? This is taken just early last week. Okay, so later we'll look at some of the actual charts, right? That's updated because this slide was prepared early last week. Okay, back then when I was preparing this, we saw that the pound versus the dollar yield is down. Okay, the blue line is down, but the pound dollar is going up, right? So at that point in time, it kind of suggests that, okay, maybe there's something that we can look out for. Okay, but of course we need to look at the updated ones, okay, which we will by the end of today's presentation here, we'll go into a live environment and share with you some of those opportunities. Okay, so this was taken back, and you can see on the right hand side, right? The yield is coming down, coming down, coming down, and then the pound dollar price has been going up, right? So this kind of gives us that divergence. But Aussie dollar, same thing, right? Early last week, we kind of see that price is going up and then the yield is coming down, right? So this is like an early sign of a divergence, right? So every time you see a divergence, that's where you want to take note, right? It's not like immediately you go and buy or sell, but it's telling you, hey, pay attention, an opportunity is coming. Okay, and then from there, that's where we want to capitalize on it via two other factors. Okay, one is what we call here high impact news. The other is we need to still take a look at the technical price point. Okay, now what is high impact news, right? A lot of times traders would go over to like Forex Factory, right? And then they would look at the red color ones, okay? And then they would say, oh, red color means important, okay? To a certain extent, that's the easy way out. But when we talk about high impact news, we are referring to news that is most important in the current context. Okay? So case in point, right? If you take a look at what's happening in the US right now, I think the most important data, I think also is inflation. Right? So maybe employment, not that crucial. It's still important, but the most important, the top priority is going to be inflation data. Okay, and that becomes like what we call high impact news. Now over here, when we trade, when we approach using this technique, right? Approach the market using this technique. We are not just simply trading the news, and then when we see a good news, we buy it. When we see a bad news, we sell it. No, we don't do that. Okay, we are actually using this to help us understand when will the market move with high volatility. Okay, volatility is a measurement of how much price moves. Okay, the bigger and the more important the news is, the likelihood of price moving a lot is higher. Okay, and that's something that we want, because if today we want to trade the market, we want to enter a position, we want the market to move fast and of course in our favor. Okay, and that's where your profit comes in. Okay, so over here, high impact news is what we can leverage on. Okay, so that's where I mentioned such events provide volatility in the market. Now, some traders like to use the news to project the direction. Okay, I don't really do that. I use other techniques to help me determine the direction that I want to trade. And then I use the news to tell me, okay, at this point in time, there's a high chance the market is going to move. Okay, so the direction, I use the yield differential, and then I use technical analysis to guide me in the direction. I use this high impact news to guide me in terms of my timing. Okay, so I know, okay, when to take note of. Okay, so for example, right, just I mentioned the Fed's primary concern right now is going to be inflation. Okay, and therefore anything that deals with inflation is considered high impact. If you actually take a look at last Thursday, we do have the CPI year-on-year data. Okay, and the market previous CPI data was 8.2%. And this time round, the CPI data came out was 7.7%, which means it dropped, right, about 0.5%. Now, that means that inflation is no longer that high, and the market digested the information and say, okay, maybe the Fed doesn't need to increase rates so aggressively anymore, and therefore they sell off the dollar, right? And then what you observe on Thursday is the dollar actually sell off very aggressively. Okay, so that's where you can see the impact of such event creating that kind of volatility in the market. Okay, so that's something I want you to understand. So when you are looking at economic data or news events, right, you want to have this perspective. Okay, trade the expectation and not the data itself. As I mentioned just now, sometimes traders like to look at the data, good data they buy, bad data they sell. Sometimes it works out, right? But it's not something that I use to approach when I trade it. Okay, because I want to then go deeper. I want to think, okay, now if this data comes out like that, how would the market think? Okay, how would the market react from there? Okay, so that's where the phrase comes in, right? Trade the expectation, not the data. Okay, and you might heard of this term before, what we call price in. Okay, let me explain a little bit what this means. Okay, now if today I tell you that next month, okay, let's say in December, okay, there will be a shortage of food. Okay, just for example, right? Let's say the government announced this information. In December, there's going to be a shortage of food supply. What would the general public do? Okay, I think this happened in COVID period, right? When there's a lockdown, and then what people do, they go to the grocery store and then they start to hog up. Okay, go and buy their tissue roll, instant noodle, canned food. They start to buy a lot of all this, even if they don't need it so much, they will just buy. Okay, so what is this human behavior? It's called pricing in mechanism, right? Because there's this information that tells them, okay, there's something bad coming. All right, it's not like it's already there, it's something bad coming, haven't happened yet, but they start to prepare for it, right? They start to take action. So this is human behavior, and if you put that into the market environment, is what we call price in mechanism. Okay, so in the market, when the general consensus expect something to happen in the future, they're not going to wait until that thing happen and then they take action, right? They're going to take action today in expectation that the future thing is going to happen, right? So that's what we call price in mechanism, and that's why it's not so straightforward to just trade the data itself, because the market has always this mechanism ongoing, right? The data released, people would then look to the future, digest this data, what is going to happen in the future, and then they start taking action now based on that. Okay, so you need to understand it from this perspective, right? So market price move in anticipation of what will happen and not what just happened. Okay, just kind of have that sink in a little bit. Okay, it's not really related to FX, but if you're looking at crypto news recently, you know about FTX, right? Okay, and that has a ripple effect to even Solano. Okay, nothing has happened in Solano yet, but what happened is people are now fearful, right? What if something similar happened to Solano? Then it's very bad. So what they're going to do, they're going to do something today in anticipation to protect themselves of the future. Okay, so all the time in the market, you will see this price in mechanism. Okay, so as a trader or even an investor, right, you want to have this perspective so that you can always be like 1 or 2 steps ahead of the market, and not like, oh, this happened, let's do it now, right? It's probably too late because people are looking into the future. Okay, so always have that in mind. Okay, so this is like a very simplified example that I have on the slide. For example, if the data leads to higher inflation, traders will start pricing in that the Fed will hike rate further. Okay, so they are actually not trading like the data itself, okay, because a lot of times people think, oh, the data is good and therefore people are buying. It's not really that, but it's really because the data is good. It suggests that the Fed is going to do something in the future, and then the traders are taking action based on that. Okay, so same thing. Thursday CPI was bad, right? It was like 8.2, it dropped to 7.7, right? It's still high, but it's not as high. So what was the price in mechanism? The price in mechanism is, oh, okay, there's an effect of interest rate playing out right now. The inflation is no longer that scary. It has already an impact on it. Then they will start to think, okay, maybe the Fed will not hike so aggressive anymore. Let's sell the dollar. Okay, so that's where the price in comes in. Okay, so this is something that I want you to really understand, right? This principle of it, because whenever you look at the financial market, okay, always have this perspective and think about the price in mechanism. Okay, so that's like 1 or 2 steps ahead of the market. All right, so always stay 1 or 2 steps ahead. Good. So over here we have this phrase, right? News creates volatility, but not necessarily gonna give you a clear sense of direction. Okay, because nobody will know what the actual data is going to be released. Like nobody knows CPI is going to be 7.7 this time. Okay, I mean, if anyone knows, the market would have moved even before the news comes up, right? So nobody knows, but we know that that is a very important piece of information, and therefore the market is going to react from there. Okay, and that's what we meant by volatility. And what we love about volatility is because it's going to move in such a manner. Of course, it can be like good in a way where your trade can be very profitable. The not so good side, of course, is you might lose a trade. Okay, but that's part of trading, right? There's nothing certain about it. Okay, but it becomes an opportunity. Okay, so you just need layers of protection to manage your risk, and then you ride the upside of it. Okay, so that's the whole idea, yeah. So in short, okay, that's why here when I'm preparing the slides, the CPI data was not out yet, right? So I actually utilized the NFP data. Okay, so if you look at last week's Friday NFP, okay, that's the non-farm employment change, yeah. So the data comes out 261,000. It's green, which means it's better than what the market has anticipated at 197K. Okay, but what happened to the dollar is the dollar weakens. Okay, so this is where, a lot of times people say, oh, NFP is very important, and then you look at NFP and then, hey, this time around NFP is good, but how come the dollar sell off, right? So that's the part where I want you to again understand it doesn't mean good data, the currency would rally. Okay, you want to come from an angle of, okay, right now, what data is important? NFP is not the most important data anymore. Okay. In fact, it hasn't been one of the most important data for some time already. But what is more significant over here is unemployment rate actually increased by 0.2%, which is something that has been talked about as well, right? About recession coming in 2024. And unemployment rate rising can give clue that a recession is indeed coming. Okay, and that's where the market starts to do that price in mechanism, right? If there is a recession coming very soon, inflation will come down, and then the Fed, because of recession, will start to cut rates, right? So they are again pricing in all this possibility, and they take action first before it happens. Okay, and that's part of the reason as to why we saw the dollar weaken on last Friday's NFP. Right. So of course you can also put this into Thursday's CPI data, right? The dollar weakens as well. Okay. So why is because NFP is not important, and we always stress the focus right now is inflation. Okay. And of course, unemployment, as I mentioned, right, can have a ripple effect. If unemployment is, this one here is typo. Okay. Unemployment increase, which means more people are not employed, right? They don't have a job, then people would tend to spend less, right? And spend less means inflation would drop, and then we'll go into a recession, and then the banks would then need to cut rate from there on, right? So the market is pricing in all this, right? So this is the part where it has then a ripple effect and an impact in the dollar. Okay, so that's where you need to think like a few steps ahead, right? Always say in anticipation of what will happen, price that in. Okay, so it's not so easy to just trade off the news, okay? But what we observe is news can give us that volatility, and we want to capitalize on that, okay? So that's the part where we then progress towards like using technical analysis, okay? Because we want the best of both worlds, right? We want to leverage on news because news gives us that timing in which there's a good chance the market will move. But we need to have some sense of direction, okay? Do we buy, do we sell, right? So where does this sense of direction comes from? It comes from technical analysis, it comes from yield differential. So if I at this point in time give you a big picture understanding, right? The yield differential highlights which currency pair has an opportunity to keep an eye on, okay? So can give you that filtering process. The news, the high impact news can give you the timing to focus on, like, which date, which time there's this high impact news, you need to pay attention to it, the timing element. And then the technical analysis can give you the sense of direction, right? Where to buy, where to sell. Okay. So TA here is where we want to acquire certain patterns that has what we call reliability factor, which means it has a high probability of repeating itself. Okay, so that's the whole idea of it. Right, and then we look for that, we execute a trade. Okay, so over here, I'm gonna share with you some simple technical patterns that we can utilize to combine, what we've covered so far. The first one is the impulse then correction setup. Okay, so over here, basically, let me just show you the visual of it so they can take a look at it. The impulse then correction pattern setup is basically, you see on the chart a very strong move, and then after that the market stalls, right? So if you take a look at this over here, okay, initially we had a very strong move to the upside, the market stalls. This is the setup, right? So what is the probability is that the direction will continue in the previous upside, right? So previously it went up, so we expect this to continue to go up, right? So you have this fast move, this slow move, and then we expect this to go up again. Okay, so this pattern here has a very high reliability because high chance it will happen like that. Okay, so Same thing. If it's coming down, what you see over here, you have a strong move down, a sideways move, you expect this to come down, sideways, you expect this to come down, sideways, you expect this to keep going, right? So this is a pattern that has already completed. Okay, so what does this mean is that moving forward, if you see something similar like that, right, before it happened, like example, this one you see over here, we have an impulse up very fast and then a sideways move. This tells us there's a good chance the future move is up. So we can't get a sense of direction on there. Then of course, what we can do is we combine. Okay, so when will we have a high impact news? There's a good chance the market will move. We have the direction here. We want to focus on the buy. Okay, and then if you look at the U differential, maybe that's where the confirmation comes in. Also look for buy, and then we combine it with a high impact news, right? So we find, okay, maybe at this date, this time, there's a high impact news coming in. The market would likely move. We already know which direction to focus. Okay, so that's the idea of it. Okay, yeah. This is opposite direction, right? So when you see an impulse drop, a sideways move, you expect this to continue moving lower. Okay, now the other setup, okay, is what we call a crawl. So today I just share with you two simple patterns. A crawl, if I show you the visual perspective of it, okay, it looks like that, right? So it goes up very fast and then it starts to slow down. This suggests a reversal. Okay, so same thing over here. If it comes down initially very fast and then it starts to slow down like that, you look for that reversal. Okay, so a crawl setup is a reversal trade as well. Right. So in the future, if you see something like that, you have a very fast move and then it starts to slow down, you look for that sell. That's again a high probability of that happening, right? So this kind of gives you that sense of direction. Okay, yeah. Same thing over here. If it came down initially very fast and then it starts to slow down, that's a crawl. You look for that reversal for the buy trade. Okay. So when we start to put all this together, right? Later on the chart, I'll show you some examples of like how you put in your entry, your stops. Okay. The first thing is the first step, right, is to take a look at the yield differential to spot for divergence, because when there's a divergence, that's where there's an opportunity coming. Okay, and that's where we're going to focus on that currency pair from this perspective. Okay, and then the second step is to take note of high impact news, right? Because that's where we understand, oh, there's a good chance the market is going to move. We want to pay attention to that. Okay, and the third step over here is to use the technical analysis to give us some kind of timing, where to buy, where to sell, the direction, does it confirm it? And then we look for the setup. Okay, so using this approach here is really just these three steps, right? To identify opportunities that we can trade. Okay, so let me bring you over to the chart. Okay, I've already prepared some of the lists over here. For example, this one that you see right now is basically, if you see at the top left, right, you have the DE 2-year yield minus the US 2-year yield. So what we are looking is basically German minus US, right? So this one here, we're more interested in the euro dollar, right? So if you take a look at it, this is on the daily chart. So recently we have the yield differential going up. Okay, so if you compare this chart, let me add the euro dollar in. Okay, what we want to observe is there a divergence, right? So in this case, you can see, oh, perfect. Okay, both are going up. So there's no divergence, right? So from this perspective, then euro dollar is not something I want to focus first. Okay, then we look at the GB 2-year yield minus the US 2-year yield, right? So what is this? We are actually comparing the UK against the dollar, right? So the chart here to compare is, of course, pound dollar. Okay. Whoops. Okay. So we take this, we compare the pound dollar. Okay. Over here. Okay. So in this case here, right? Can you see that both are also going up? So there's no divergence, right, between the differential and the actual price. So maybe this point in time, nothing much. Okay, so you repeat this, right? So you look at Aussie okay, against the US dollar. Oops, wrong one. Okay, so we compare. Okay, as of now, okay, we have the yield starting to go up a little bit. The price of Aussie dollar has went up quite significantly. Okay, so maybe right now we don't have a very obvious divergence, but suppose, okay, you keep track of this. Let's say maybe next week, this one here starts to come down a little bit. This one still goes up. That's where you get a divergence build up. Okay, so this one might happen, but we just want to give it a little bit more time first. Okay, so let's take a look at another one. This is the dollar CAD. Okay, so we're going to compare the dollar versus the Canadian. Okay, not much of a divergence as of now, but you can see this one here seems to be going up. Okay, if let's say next week this one starts to go up, this one continues to drop, then that's your divergence. Okay, so this one I think an Aussie building up, but not yet. Okay, then let's take a look at, oh sorry, that's the dollar yen. Oh, sorry, this is the dollar. Okay, this is the dollar index. This is the dollar CAD. Okay, so this one here, dollar CAD. Let's compare. Okay, now dollar CAD, can you see we have a little bit of an upside? Okay, but this one is coming down, right? So this is what we call a divergence. Okay, just double check. Yeah, this is the dollar CAD. Okay, so what this means is from the yield differential perspective, okay, there is a divergence happening, and it suggests that okay, maybe dollar CAD has a potential of a U-turn. Okay, you can see right before this part here, what we have last time was that this was going up, the white line is going up, the orange line is coming down, and then after that, what happened? A reversal takes place, right? Again, it's not 100%, but that's where the probability kicks in, right? It tends to reverse and come back. So right now, what we see is we have a divergence. Okay, we have a divergence. So this tells me, okay, from this perspective, dollar CAD starts to pay attention to that. Okay, so the next step is what? The next step is for me to go and understand, okay, if dollar CAD, I want to take note of, is there a news coming in for Canadian or the dollar? Okay, so now if you take a look at this here, right, this is next week's calendar. Okay, I think very first thing that you can pay attention to is we have the Canadian CPI coming in, right? So this one here is on 16th of November, which is this coming Wednesday. Right, we have Canadian median CPI year-on-year, trim CPI year, of course, a common CPI year. Now, again, we know inflation is important now. CPI is one of the inflationary data. This is going to be crucial for Canadian. Now, obviously, we won't know the exact data that's going to come up, but we can start to anticipate it will actually give us a high volatility impact. Okay, not all the time, but there's a possibility it will. Right, so we kind of have a little bit of a timing here, right? Wednesday, 9:30 in Malaysia and Singapore time zone. Okay, so this here from a dollar CAD yield differential, it leads us to start focusing on dollar Canadian. It tells us that on Wednesday, we have a high impact Canadian news. So what we then now need to do is to look at dollar CAD. Okay, so now let's take a look at dollar CAD chart. Okay, so we can actually use back, take away that, right? Use back the daily time frame or the forward chart time frame, and we look at the technical portion. Now, if today we have a divergence on the dollar CAD yield differential versus the dollar CAD price, it kind of suggests that there's a good chance this will reverse, right? So what we need from a technical pattern is a confirmation to look for that buy. Obviously, right now we don't have, but now to Wednesday, which you have Monday, Tuesday, and maybe first half of Wednesday, you have about 2.5 days for a pattern to eventually play out over here for dollar Canadian. Now, let's say, okay, we talk about the crawl pattern. Okay, if you still remember, let me bring that pattern out first. Okay, we look at this crawl pattern. Okay, so whenever we see this crawl pattern, we look for the sell, right? So whenever we see this crawl pattern, we look for the buy. Okay, so from dollar cap perspective, if you still recall, we are looking for the reversal, which means we want to look for the buy, right? Potentially the buy. So what we want is this pattern. Okay, so we want to see an impulse and then we want to see a crawl. Now, if you go to the chart right now on dollar cap, right, at least on the 4-hour time frame perspective right now, we have this little impulse drop. Okay, now if let's say Monday, Tuesday, and first half of Wednesday, it builds up like that, then what do you have? You have a very nice little crawl. Okay, so this gives you an opportunity to trade the Canadian news on Wednesday evening for a potential reversal upside. Okay, to capitalize on that, right? So you build from fundamental, go to the news, come to the technical. Okay. Obviously, the prerequisite is what? You need to see this technical setup. Okay. Now, I just show you some example that, might have taking reference point from, some of the chart patterns that have happened in the past, So if I take this here, okay, let me, sorry, not this one, over here, okay. So now let's just take maybe this one, okay, and then duplicate an example, right? If something like this developed here by Wednesday, okay, maybe not exactly the same, but something like that. So what we can then see is, oh, we have a little crawl pattern that is developing here. Okay, so how to trade this crawl? Okay, the idea here is if today you have this little crawl, you want to buy, right? Because this again, we have built up that direction to focus. So you want to buy the reversal, you look for the crawl for a significant mini high, right? So in this example here, this is your mini high. Okay, you take that reference point as your what we call breakout entry. Okay, your low point here becomes your stop loss. Okay, so how to trade this is you put in not an immediate buy, but you put in a pending buy stop, which means if the news comes out and the price indeed reverse, okay, and it should go fast, right? Because that's what we anticipate. Then this becomes your breakout entry at 1.3285. Okay, based on this example right now, because we need this to develop first, then we can have that buy stop, right? So that becomes your entry, and then the stop loss over here is right now, based on this example, is 3150. Okay, the low that you're gonna see on Wednesday. Now, once you have this, your target here, initially, if you're fairly new to this, right, you have no idea how to put your target, you just set at least a minimum 1:1. Okay, so if you're gonna put a buy there, you're gonna put a stop here. If let's say your stop loss range is 130 pips, you just simply target 130 pips. Okay, you at least just put 1:1. Okay, that's like if you have no other experience of how to take profit, okay, just set 1:1. The simplest way. Okay, but of course, if today you have more advanced strategy and things like that, you can of course have take profits 1, 2, 3, or even manage it according to trailing stop, etc. Okay, so this is one of the method that you can use to help you in identifying opportunities. Okay, now it's not going to be like, oh, every day you're going to have a lot of trades, right? But this is more like a trade plan for you to prepare from a fundamental point of view, going into using a news event, which is very specific. Like this time around, we have the Canadian on Wednesday, 9:30 evening in Malaysia and Singapore time zone. That becomes, you focus on that day. Okay? I'm not saying that you're definitely going to get a trade on that day, but that becomes your trading plan. Okay, you prepare for it, you build up for it. Okay. Now in the event, right? So let's talk a little bit in terms of like what happens if the news comes out and then there's nothing. Okay. Now in the event that you have everything, right? You have that little crawl that we talk about. Okay, you had that little crawl here that we talk about. You have this pattern. Okay, you waited for the entry, you put in a buy limit. Okay, the news came out and then this one just dropped. Okay, that can happen too, right? Because I always say, we don't know what the news is going to come out. Okay, but if let's say the data comes out and then the dollar can just drop, right? Then to you, none of your concern because you're looking for that reversal and it didn't break this high, you did not get involved in the trade, it's fine. Then you just wait for the next opportunity, right? You repeat the process to source for another trade setup. Now, in the event, if it goes and then, after that, it pulls back a little bit, this is the part where you need a little bit of experience to manage the trade. Okay. So there are only a couple of possibility of how things can turn out, right? And as a trader, you basically just want to prepare for those different possibilities. One is it goes down, none of your concern, you're not in the trade, just look for the next opportunity. The second scenario is it goes up and beautifully, that's a very good trade. You just manage it along the way. Or it can go up a little bit and then comes back down. It's fine. You have to stop to protect this trade. Maybe this doesn't play out, you get up. Okay. So think of all the different possibilities that can happen, and mentally you need to accept that. Okay. That's how trading works. Okay. It's all about probability, and you just need to manage those probabilities. Okay. So this is the part where I would want you to take away what we covered with you here today. Put that into practice, go and search for opportunities. Again, as I mentioned, it's not going to be every day you're going to have it. Okay, but this is something that can complement whatever maybe potential strategy that you already have. Okay, so this is where almost, I would say, almost every other week, you might get one or two, because if you look at the event calendar, right, next week here, obviously we have the Canadian that is important, right? If you go forward a little bit, like the following week, right, you have some very important one like New Zealand over here, right? And then you go forward even another week, okay, into early December, we do have again the Canadian and the US data here. Okay, core PCE price index is also pretty important for the US. So almost every other week, you can't have like a high impact news, right? So if all of those factors kind of align, right? So you have a yield differential, divergence, you have a high impact news coming in, you go to the technical, you source for the opportunity, the pattern, almost every other week, you have something for you. Okay, but this is not something that every day you trade the market, right? But every week, you can source for something, right? So hopefully that can complement whatever strategy that you already have. Good. Okay, yeah. So cool. So over here, I see some questions. So maybe let me address those questions. Okay. If you have any questions, from today's sharing, maybe not very clear, feel free to put it into the chat box as well. Okay. Christine here asks, the crawl versus correction looks pretty similar. Hard to differentiate. Sometimes on the actual chart, right, it's not so straightforward and clear cut. But let me find you example that can give you a slight understanding of it. Okay, first let's talk about correction. Okay, of course, not all the time you're going to get so beautiful correction, but this is one example of it. Okay, so this part here. Okay, so you can see very strong move to the downside, and then basically a little bit of a sideways move, right? So correction, I think, should be quite clear, right? This is an impulse, this is a correction, then you expect this to drop. Okay, a crawl, let me find, example of that. Now, a crawl has a little bit element of when this drop, and then this starts to slow in the direction of that drop. Okay, so that's a crawl. Now, a crawl, the nature of crawl is also slow, but the direction of how the market develops in relation to the previous move, that's the difference. Okay, so you take a look at this one here. Previously, it came down fast, and then it slows down in the same direction of that drop, right? So that becomes a crawl. Over here, if you take a look at this, we have a drop, and then this little move that is slow is actually going in the opposite direction of the drop. Okay, so that becomes a correction, right? So that's how we differentiate it. I mean, from a visual perspective, some of the crawl versus the correction can be very clear cut. Sometimes it's not clear. Okay, so again, if things are not clear, stay out. Okay, I always say just focus on the things that are clear to you. Okay, so that's the difference between crawl and correction. Yeah. Okay. Okay, Immuno here says I placed a trade on dollar CAD, and the trade opened 60 pips away from the original price. Yeah, that's what we call slippage. Okay. That is a potential risk that you need to factor in if you're looking at news, right? Because it also depends on the liquidity provider. Okay, I mean, today, if let's say certain brokers doesn't have a very strong liquidity provider, you're gonna experience a lot of slippage. Okay, slippage in the market basically means that you want to get in at a particular price, but there is no available order to enter at that price point. Okay, so what will happen is the brokers will then search for you the next available price. Then they keep searching until, oh, there is this price that can get you in. Okay, then what will happen is they will execute that order for you at the next available price. Okay, so in that case, that's what we call slippage. Okay, now it doesn't really happen often. Okay, however, if you start to experience that a lot of times, you might then want to compare and try out maybe another broker, because this is really due to liquidity provider issue. Okay, but if let's say you experience it maybe out of maybe 10 trades when you trade the news, right? Maybe got two trades that happen, something like that. It doesn't slip a lot. Maybe it slip a little bit, a couple of pips. Quite common. Okay, so that's something you need to also understand, right? So this is about liquidity provider. Question here I see also is how do I pull out the US 20-year minus the CAD? Okay, good question. So very simple. Okay, what you do is you on TradingView, right? You can do this. Okay, you click on the symbol search on the top left, and then what you do is you type it in, right? So in this case here, you want to do like US versus CAD, right? So you type in the US 2Y, sorry, 02Y. So this one you can see, right? US 2-year government bond yield. Okay, you don't click it, you don't press enter first, you type minus. Okay, so on TradingView, you can actually use this formula, right? So over here, you can also see this minus sign. Okay, and you click it, and then you type the Canadian, right? So Canadian over here, okay, CA202Y, right? So this is the one. You don't click this because you have already typed in this formula. You just click enter. Okay, so what will happen is that it will bring out that chart, right? So you can see on the top is basically the formula that you've keyed in. Then, of course, you don't want the candlestick because it can be quite difficult to interpret. You just change it to a line chart. Okay, that's how you extract the yield differential out onto TradingView. Okay, yeah? Good. So I hope that helps. Yeah, so Mary also asked this, right? How to get the yield difference between two currencies in TradingView. That's how you do it. Okay. I did not prepare the yen here. Okay, I did not prepare the yen here. But if I'm not mistaken, yeah, I'll probably need to type it in now to find for you, right? Because every formula is a little bit different, but it's over here. JPO2Y. Okay, so that's the Japan one, right? So what you can do is if you want US yen, right? So you use USO2Y, okay, minus JPO2Y. Okay, so you take this. Oops. Okay, mistake. Okay, correct. So this one here is your Japanese yen, right? So what I do is I need to add this in, so I'll have it, and then you can compare this again with the dollar yen. Okay, so you see, right now, as of this here, we have a little bit of divergence, right? I mean, the yield seems to be starting to bounce up, but dollar yen is falling. Okay, so maybe by next week, if you give it a little bit more time, right, this one goes up, this one doesn't really goes up, this one still continue to drop, then you have a divergence on the dollar yen. Okay, so that's the one. Okay, so yeah, hopefully this helps you to pull out those charts on TradingView. Okay. Sally here asks, why do you use the 2-year and not the 1 year or even longer? What we found is, you of course can go and study and compare it yourself, right? What I found is that the 2-year gives us a very good relationship with that particular currency. Okay. If you look at 1 year, sometimes it can be too sensitive. Okay. Anything more than 2 years is a little bit long, right? Because we are not like really looking for long-term investment on the currencies. We're looking for trading, more of like swing trade. So what I figured was like 2 years can give us the closest relationship. Okay, but of course, feel free to play around with it, right? Sally asks, the divergence indicates potential reversal, right? Yes, okay, correct. So whenever we spot a divergence, it gives us an opportunity to look for a reversal. So like case in point, just now we talk about dollar CAD. If you look at dollar CAD price and the yield, we have a divergence, right? So the differential is going up, but dollar CAD is coming down. So there's a good chance this would converge. Right? So that's the whole idea of it. Patrick asks, do we need to consider the real yield differential? For me, I don't want to overcomplicate the whole process, right? So we're just basically looking at the two currencies in terms of the government bond yield, right? I don't think you really need to consider that real yield because we are basically looking at a ratio, right? I mean, there might be a slight difference. But again, as I mentioned, I don't want to overcomplicate this entire process. Therefore, I'm just basically looking at yield by itself. Okay, and then I take the difference between it. Okay, okay, Wilfredo asks, how do you know it is time to trade after seeing a divergence? That's where we actually have the high impact news as the first layer to tell us, okay, when you want to focus on it. And then we have the technical, okay, to tell us like, is there a confirmation, right? Is there an entry point? Okay, so this yield differential divergence is basically highlighting the potential opportunity. It doesn't tell you to trade immediately, right? And then the news that is potentially upcoming, the high impact news, give you the exact time that there will be a catalyst. And then the technical gives you that confirmation and the details as to where to put your entry, where to put your stops. Okay, so you need to combine all this together. Sally asks, are you swing trade intraday or scalper? Definitely swing, right? So again, this technique here might not work effectively if you're doing scalping, but it's more towards like swing trade, right? Because whenever you talk about fundamentals, it's very hard to scalp it, right? Because fundamental is a little bit more towards swing trading or even mid to longer term perspective. Okay, so hopefully that helps. Okay. Good. So I hope so far so good. Hopefully you guys understand what we've covered so far as well. Okay. And you know, take this, go and practice it. Go and play along with it on the chart to really see it for yourself. Okay. And hopefully that gives you some different methods that you can utilize to help you or even complement whatever strategy that you already have, right? Good. So some closing notes for today's session over here. Okay. First up, this session over here is sponsored by Zenfinix. Okay. So for those of you who are not aware, what you can do is that, of course, some of you actually join in through my mailing list. Some of you got to know about this event, directly through Everything Trading, which is a partner of Zenfinix. So over here, just a quick one to share with you what they are offering or what is the offers that they have right now. Okay, is that if today you decide to register your account with Zenfinix, get it verified, and then you make a small deposit of $100. Zenphoenix have a current promotion running, which they will give you an $88 credit bonus, right? So in total, then you have like 188 that you can use to trade in your account. Okay, so for those of you who are interested, do reach out to Zenphoenix. You would probably already have their WhatsApp number. If not, then I would just request the team over here to put in a link where the participant then can reach out to you, right? Okay, yeah. So that's a quick one on them. Today, if you're on Telegram, if you're not in here yet, this is free. You can join in. Okay, just scan the QR code. It will lead you to this channel called Zenphoenix Trading Those Telegram. I post a chart inside it every day, okay, except Saturday and Sunday. Okay, so this one here, basically, I will search for one chart that I feel that is interesting. Then I'll post it into the Telegram group channel over here, just to highlight potential setups that you want to take note of. Okay, it's free for all of you who join in today's webinar. So just scan the QR code. It will lead you to this channel, and then you just click join. And then if all things are well, you should be able to join into the Telegram channel. Okay. You can also scroll through and see what we have posted in the past, right? So that's the one. Very quickly over here as well. I want to just highlight, because this is still ongoing. There's a lot of fake accounts out there using my name, using my profile, to reach out to potentially any one of you, and then they like to share like, oh, I'm running a new course right now. I have this investment plan, etc., and things like that, and then ask you to transfer cryptocurrencies to them, okay, or sort of, okay, whatever it is. Those are fake accounts, okay? So I just want you to be very, very careful, because for me, I do not reach out to you personally to ask for funds, ask you to, buy any course, ask you to invest in any funds and things like that, right? So all those, just be very, very careful, okay? So for those of you who really wants to connect with me on social media, I only have one Facebook page and one Instagram account that I post more on trading and investing related stuff, okay? And just take note of the URL, okay? So you can see on the screen here, the URL behind is always my full name, right? If it's not like there's a dot, there's an underscore or whatever it is, those are not my account, okay? So I just want to highlight over here, because as of this morning and yesterday, there's still fake accounts reaching out to people, and then they notify me, right? And I told them that's not me. So I just want to stress, every sharing I do, I just try to educate you guys as well, be aware of it, okay? Because I don't want you to then fall, be a victim of all the scams that's ongoing, yeah? And last but not least, I also have something to offer for you in terms of a 7-day free trial. I have this Trading Those Premium Analysis. So every day, I do a report, I prepare an analysis for the day, and then I share it with the members. So over here, we cover basically the major FX pair like euro dollar, dollar index, pound dollar, Aussie dollar, dollar CAD, dollar yen, including gold, S&P, and crude oil. Okay, so this is a daily report that's sent to your email, covering all those in terms of a 4-hour chart, right? So it's for swing trading. So inside the report will tell you, okay, today, which direction I'm looking. Do you want to focus on buy, sell, or remain neutral? I would have some key levels to help you identify for entry, okay, if there's a setup, okay? So it's not a signal, it's an analysis to complement your trading, right? So if today you're looking for like trade signal, this is not for you, okay? This is purely to support and complement your trading, okay? So a lot of traders probably would have a little bit of experience in trading already. They would want to have a second opinion, of an analysis, then this would come in very handy for them, okay? So the 7-day trial basically is for free, okay? It's for you to test out and see if this is something that value adds to your trading, if you want it or not. And then after that, if you want to continue after 7 days, it's very affordable at $7 per month. Okay. If you're in Malaysia, that's like what, 30 ringgit a month. I mean, it's very, very affordable, right? So if you're interested to try it out, same thing, you can scan this QR code. It'll lead you to a page where, you still need to key in some information. But the first 7 days, you're not going to be charged. It's going to be free. Okay. So if after 7 days, or let's say within the first 7 days, you feel that, okay, this is not something that you want, you can cancel it before it charges you and then it becomes free. Okay. If let's say you enjoy it and you want to continue, then you can just let it run. And then that's how it goes. Good. Okay. So that's a quick one. To do some closing note, I see one last question over here from Sally, asking what's the leverage given on Zenfinix. If I'm not mistaken, it goes as high as 400 or 500. Okay, this I'm not so familiar with. I mean, to me, leverage is not the most important thing, right? Because if there is 100 times leverage, it's more than enough for me. So I'm not too particular in terms of like what is the leverage. Okay, but if I'm not mistaken, they can go as high as like 400 or 500. Okay, this one you probably need to go and reach out to them to clarify on it. Okay. Nicholas asks, is Zenfinix connected to MetaTrader? Yes. Okay. They currently have MT4. They're developing MT5 for their stocks CFD. Okay, but they have not launched the MT5 yet. Right now, it's still on MT4. Mark asks, am I related to Infinox? The answer is no. I'm not. I'm not sure if there's anyone using my name or profile, but I'm not. Okay. Good. Okay, so I hope today's session has been helpful. For the replay, I see if I can get it up for you guys. Okay, but no promise in terms of the recording. Yeah. Good. Okay, so again, they have dropped the link there. So if you would like to find out a little bit more, just feel free to reach out to them directly. I mean, that's the WhatsApp link. You can WhatsApp them directly, and then if you have any questions, okay, feel free to just let them know. Good. Okay, so that's all from me for today. Okay, again, hopefully it helps to give you a different angle and insights into the market. Okay, so all the best to your trading. With that, I'll see you guys soon, right? Again, all the best to your trading, and bye-bye.